Banking! Canada's mortgage rates are on their way up on rising bond yields, as better than expected employment data in Canada, and even more importantly, the United States, are sending bond yields and thus fixed mortgage rates higher. However, despite, as we'll see, higher fixed mortgage rates coming to Canada, we are continuing to see reports of lower mortgage rates.
Whatever it takes. Whatever you need.
But those articles are talking about variable mortgage rates, which, as we'll see, are dropping, with many, including the usual suspects, arguing that said rate drops will push the real estate market higher. Yet, even perpetual variable rate cheerleader Rob McClister, who pushed variable rate mortgages for a good portion of last year, is starting to backtrack, noting the potential risks in taking on a variable rate mortgage, which leads to a number of questions. What does the current variable v fixed landscape look like starting out 2025? What are the risks going forward? And what are the implications? So what I want to do today is go over my best mortgage rates for the month of January, take a look at the mortgage rate landscape and the choices facing Canadians, and then go over some implications for the real estate market. As we'll see today, while many are scaling back their rate cut bets for both the Federal Reserve and the Bank of Canada, the outlook is definitely cloudy. We may get a quasi-hint as to where the Bank of Canada is heading when it makes its interest rate announcement and press conference on January 29th, and we will obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First off, a brief side note. I just want to get this out of the way real quick, as this projection from the banks has been making its way around real estate and mortgage land.
Where people throw ducks at balloons and nothing's the way it seems.
The document is showing the rate projections coming from the big six banks, with some noting that the Bank of Canada could be cutting by 125 basis points this year alone, bringing the policy rate down to 2% by the end of 2025. And while this very well could be the case if the economy turns, take a look at these same rate projections from back in early 2022. With the banks predicting on the high side a 2.25% policy rate by the end of 2023, back when inflation was at an 18-year high of 4.7.
I had to quit school in 11th grade.
At that point, some 57% of new borrowers agreed with the bank, all of which took out a variable rate mortgage. And then, of course, by the end of 2023, the policy rate was sitting at 5%. If back then you took out a $600,000 mortgage at a decent variable rate of prime minus 0.75, by the time the end of 2023 came around, your mortgage payment increased from $2,455 to $4,000. And those banks that made those predictions were now getting $3,000 per payment in interest.
Minus setback, that's all. Oh yeah?
Yeah. The point is that A, you can't trust these projections being made by the banks, because B, you can't trust predictions coming from those who have an interest in the outcome. I thought we would have learned this with loaded 2023, but obviously, given these bank projections that are making their way around, we still have not as of yet.
I'm good at stuff.
Regardless, now that we have that out of the way, let's move on to fixed mortgage rates, which have been rising, along with bond yields since October. First up, my best 5-year fixed insured mortgage rate. In insured mortgage, that's where you have less than 20% down, you have a 25-year amortization, or 30 for first-time homebuyers. You qualify at the contract rate plus 2% or 5.25%, whichever is highest, and of course you pay the mortgage insurance. My best 5-year fixed insured rate back in October was 4.19 and has now bumped up to 4.35 in January, with a decent variable rate mortgage sitting at prime minus 0.95 or 4.5%. So, insured fixed mortgage rates are up about 20 basis points as the Bank of Canada drops rates, moving ever so close to that of variable. Insurable rates are even closer. An insurable mortgage rate, that's where you have 20% down, you have a 25-year amortization or less, you qualify at the contract rate plus 2% or 5.25%, whichever is highest, and you don't pay the mortgage insurance. My best 5-year fixed insurable mortgage rate back in October was 4.64, and that is now sitting at 4.74, with variable sitting at prime minus 0.7 or 4.75%. So again, insurable mortgage rates moving up while prime moves down, now almost exactly equal to that of variable.
I'm a salesman.
And finally, uninsurable mortgage rates have actually dropped since October. An uninsurable mortgage rate, that's where you have that 20% down. Either A, take money out of your house vis-a-vis a refinance or an equity takeout, and or you have a 30-year amortization, qualify at the contract rate plus 2% or 5.25%, whichever is greatest, and of course you don't pay the mortgage insurance. My best 5-year fixed uninsurable mortgage rate back in October was 4.74, and that dropped 10 basis points in January to 4.64, with variable sitting at prime minus 0.7 or 4.75. So again, even with uninsurable, fixed mortgage rates and variable mortgage rates moving very, very close to each other. Fixed rates really no longer have that much of an advantage to that of variable. So fixed mortgage rates on their way up with, as we've seen over the past few months, the Bank of Canada cutting rates. Variable mortgage rates are on their way down, with it not taking a whole lot, maybe a single cut, for variable to actually be cheaper than fixed.
You see, I was right.
And as to the reason for the divergence, it is, as it always is, as we talked about so many times on this channel, the bond market. With the yield on the 10-year U.S. Treasury, how much the U.S. pays to borrow money, up over 100 basis points since October. And since it cost the U.S. government more to borrow money, it now costs the Canadian government more to borrow money, and the yields on Canadian bonds are also up about 50 basis points since October. And as such, as we've talked about before, if it's going to cost the Canadian government to borrow money, then it's going to cost even more for you and I to borrow money as well, sending fixed mortgage rates higher regardless of what the Bank of Canada does or does not do.
I don't understand. I mean, I don't want to understand.
Both are probably very true. But given this divergence with fixed rates on their way up and variable rates, floating rates, those set by the Bank of Canada, on their way down, it is very much possible that variable will be outperforming fixed in the near future, especially if the Bank of Canada cuts rates, which is also very possible as well. Though the recent employment data will no doubt give the Bank of Canada at least some bit of pause on the state of the economy, the economic headwinds heading into 2025 are demonstrably mounting. Without going into these headwinds too much, we have these potential tariffs coming out of the United States, with Canada planning retaliatory tariffs to follow. We have rising unemployment in some areas, and nearly half of the jobs in that blockbuster unemployment report were created by the government, with the public sector growing at double the pace of that of the private sector. Not exactly the measure of a strong underlying economy. Further, even though the mortgage renewal wave hasn't even started yet, according to the Bank of Canada's most recently released indicators of financial vulnerabilities, delinquencies are already rising above pre-pandemic levels. Granted, yes, mortgage delinquencies are low, but according to CMHC, they are doing this, moving sharply upward, which we haven't seen for at least the past 12 years. And while the usual suspects say that mortgage delinquencies aren't something to worry about because we're still at or below pre-pandemic levels, the argument that simply because something is not happening now means it won't happen in the future is definitely a fallacious one. At one point in the not-so-distant past, installment loans, credit cards, and auto loans were all below pre-pandemic levels as well, and now they're not. Regardless, we have these delinquencies moving above pre-pandemic levels, and as mentioned, the mortgage renewal wave, when all of that money gets sucked out of the economy, hasn't even happened yet. So, between the Trump tariffs, retaliatory tariffs to follow, problematic unemployment data, and the mortgage renewal wave that is very much still on the horizon, when mortgage payments, if rates are still at 4%, could rise as much as this, there is going to be a lot of pressure still on the Bank of Canada, on Governor Macklem, to cut interest rates heading into 2025.
So when?
Meaning, over the next few months, maybe even over the next few years, it is very, very possible that variable will outperform fixed. But if you do opt to go with the variable rate mortgage, and I cannot stress this enough, you need to keep an eye on A, inflation, and B, the bond market.
What are those?
If we do continue to see drastic interest rate cuts, there is a very good chance they'll be due to the Trump tariffs and the retaliatory tariffs to follow, which could very much prove themselves to be inflationary. Granted, the usual suspects and the media experts will tell us that the bank can't do anything about those tariffs, so rates will stay low. But as we learned very much with mortgage interest costs, the bank can and will raise interest rates to try to tamp down inflation nonetheless. It will try to cool off what it can, as it does not want those price increases due to the tariffs to be translated into wage increases.
That would be good.
That would be no good.
Further, when we saw that jump in mortgage rates post-October, that jump in yields, a lot of that had to do with U.S. spending. Now sitting at 6% of GDP in a non-emergency situation, the only other time spending was that high was during World War II, the global financial crisis, and COVID. There's not even an emergency, and the U.S. is pouring that much more additional money into the economy. And if you believe that government deficit spending more into the economy than you take in, especially if the Fed prints money, is inflationary,
I don't.
we know, but if you attended high school economics and you think all of that extra money heading into the economy is inflationary, then you have to A, watch the inflation rate, and B, watch the bond market, which, as of late, has been showing a very real worry over deficits, spending, tariffs, and inflation. If you do take that variable rate mortgage hoping to reap the benefits of the Bank of Canada's rate cuts, you can very much lock in at any time. The only question is the fixed rate at which you will be able to lock in. If, say, you ride that variable rate mortgage for 2 years and you only have 3 years left on your mortgage, well, you can lock that in if inflation starts to rear its ugly head, but you'll be offered the 3-year fixed rate by your current lender, which, as we've seen with the bond market, has absolutely nothing to do with what the Bank of Canada has or has not done. So, if inflation is rising and it looks like the Bank of Canada could be increasing interest rates, and that's going to be tough on the budget, make sure you're keeping an eye on the bond market. Make sure you're keeping an eye on the fixed rate at which you will be able to lock in. So, all in all, fixed mortgage rates on their way up, variable mortgage rates on their way down. They're coming very close to intersecting, and all things being equal, if the Bank of Canada continues to cut, it does look like, at least for the immediate to medium term, variable rates will probably outperform.
Yes!
As to what that means for the real estate market, if borrowers are willing to roll the dice again with variable rate mortgages, I really shouldn't say again, as it wasn't really rolling the dice back in 2021 when money printing was going like this. The result was locked in. It wasn't exactly a gamble. Regardless, if buyers are willing to roll the dice, then yes, we could see an uptick in the market. But if those variable rates have still left a bad taste in the mouths of many Canadians, which I think could be completely understandable given the news articles, then these rising fixed rates could push a lot of Canadians to the sidelines. With that said, it's still very, very early days in the 2025 market. We are eagerly awaiting January's data set to be released in a couple of weeks, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.